So the chapter of the management of the receivable. Let us have first of all an understanding that say what are the learning points that we have in this chapter. So first of all, having only a simple discussion that what are the learning points that we have say in this chapter. Dear students, say something like this. I would like to give a small example to give you explanation. I request you to remain active in the chat box. Suppose you are a managing director of a company and your company is manufacturing a product. Full stop. For manufacturing of product, a component is required to be purchased. I just request you to understand. You don't have to write anything. I'll tell you when you are supposed to write. So suppose you are a managing director of a company and your company is manufacturing a product. For the purpose of manufacturing it, say suppose a component is required. To buy component, you have shortlisted two suppliers, ABC and PQR. The component which you want to buy, to purchase it, you have shortlisted two suppliers. And suppose you have found something like this. You made a comparison that say what is the price at which say they supply the component, then what are the terms and conditions for delivery, then how is the quality, and how is the terms and conditions for, let us say, payment. You made comparison of say these things with respect to both the companies, and then say you have come across to a conclusion like this: the price is like identical, there is no change in the price. Terms and conditions for delivery is also same, there is no change between both of them. Quality is having say almost no difference, very negligible differences there. The only thing which was different was the terms and conditions for payment. ABC was say providing 2 months credit and PQR was providing 3 months credit. The credit period which is offered by both of them is different. ABC provided 2 months credit and PQR was providing 3 months credit. I request you to write in the chat box that what do you think? That say we should buy the component from ABC or from PQR. We understand that say we should buy from PQR. The answer for that is very simple. Keeping all other things same, keeping all these things same, we understand that say a company which is providing more credit to us, from that company only we should buy the component. That is over here in this example, it is PQR. This is what's the kind of the simple answer that we have. Now Listen to my point carefully. See, the way we make a comparison between or among our suppliers before we purchase the component. Similarly, can we say that, say, our customers would be making a comparison between us and our competitors? They would be making a comparison, and based on that, say, they would be taking a decision that whether to purchase the goods from us or from others. That is the kind of decision that, say, they take. Listen me carefully what I am going to speak. We understand that, say, it is very necessary to have like command over the business if you want to survive, if you want to grow. So definitely we will work best with terms of the price at which we deliver the goods. The price at which we should, that is say, we deliver the goods should be reasonable. The product which we are selling in the market, suppose it is say similar to that, the products are sold in the market for, let us say, 10,000 rupees, and we charge 25,000 rupees, then it would be difficult for us to survive. If at all we charge 12,000 rupees, then in that case it is acceptable reasonably by the customers. The terms and conditions for the delivery should be again as per the market norm. Neither it should be, say, very stringent, at the same time, say, it should not be such wherein we also bear like too much expenses. It should be as per the market norm. The quality is, say, should be reasonable in a way that, say, we have to make sure that, say, the product that, say, we sell in the market is competitive. And lastly, the terms and conditions for the payment which we offer to the customer should be as per the market norm. If everybody is offering a credit period of, let us say, 3 months or near to 3 months, and we offer credit period of only 15 days, then in that case it is not feasible. We understand that, say, in this case it will be difficult for us to like survive in the competition. This is what, say, we understand. One more a small question to all of you before we proceed further. Suppose a company is having, let us say, just an example, a credit period which is offered to the customer is 3 months, and sales of the company is, let us say, it is 10 lakhs. The company is considering that instead of 3 months, let us offer a credit period of 4 months to the customers. In that case, what do you think? Write your answer in the chat box. Sales of the company will increase or sales of the company will fall down? Please write answer in the chat box. We understand that, so the sales of the company will generally increase with the increase in the credit period. And suppose we shrink the credit period from 3 months to 2 months, then sales of the company will increase or it will fall down. Please write answer in the chat box. We understand that, say, generally sales of the company will fall down. Means we understand that, say, sales of the company will generally follow the credit period. If at all the credit period is increased, sales will increase. If credit period is decreased, sales will fall down. However, friends, profit of the company, let us say that, say, right now the profit of the company is 4 lakhs. It may happen, listen carefully, it may happen in spite of the fact that, say, the credit period increases, sales increases, it may happen instead of increasing the profit of the company may fall down. And if at all you shrink the credit period, then in that case it may happen instead of reducing the profit of the company may go up. Yes, it may happen like this. Why, sir, it will happen like this? What may be the reason? That is the learning point of this chapter. Learning point of this chapter is, listen carefully, learning point of the chapter is, what is the optimum credit period to be offered to customers so that profit of the company will increase. With the increase in the credit period, sales increases. With the decrease in the credit period, sales is falling down. However, the profit of the company may not change in the same direction. So in this chapter, we are going to have the learning point that what is the optimum time period of the credit that we should offer to the customers so that we will be able to maximize the profit. This is the learning point that we have in the chapter of the receivable management. Now friends, I just would like to tell all of you the kind of like the method that I have for teaching is like this. Usually, not every time, usually what I do is that I explain the concept and then simultaneously I'll dictate those, that is say those concepts to you or those notes to you. The reason behind that is one, when I'm dictating the notes to you as a student, you will have better understanding that say this is what sir wants to explain. That is the first thing. Second thing is that what happens later on, say when the time of the revision comes, there may be a time gap between the date on which say you have studied and the date on which say you are revising. Since there is a time gap between both of them, so when you are having such the revision, at that time if the notes are there, then in that case it would be extremely helpful to you. That is the reason say in my own words I usually dictate notes to you so that it will be helpful to you in your revision. So voluntarily you are required to write notes, but preferably whatever the experience that I have for the teaching, based on that I can tell you that say notes will be very much helpful to you later on. And notes in your own handwriting, notes which you have written will give you excellent satisfaction in your revision also. So I request all of you to write notes along with me. That will be helpful to you to some extent right now, but largely it will help you to you say in your revision. Read on heading learning point of chapter. In that write down first point, in competitive business situation, comma, it is very necessary for a company to offer credit period to customers. Second point, usually with increase in credit period, sales will increase and vice versa. Full stop. However, profit of the company may not change in the same direction every time. Full stop. So, in this chapter, we are going to learn optimum credit period to be offered to customers. Full stop. Now, friends, in this chapter, they have made a few assumptions. So, which are those assumptions? I'll explain them to you and then I'm going to dictate them to you. You don't have to write them initially. First off, I'm going to give you explanation about the assumptions that say they follow. Throughout the chapter, a few assumptions have been made like this. First assumption, all sales are on credit basis. So the assumption is made that say whatever the sales of the company is entirely on the credit only. Unless we have been provided that a certain portion of the sales is on cash basis. Second assumption is made like this. Activity level of the company is evenly spread throughout the year. I give you explanation by say taking a small example. Suppose a company has annual sales of rupees 12 lakhs. So the assumption is made that monthly sales will be rupees 1 lakh. That is the simple assumption is made. So whatever the sales of the company is evenly spread throughout the year. Yearly sales is an amount of 12 lakhs. So 12 lakhs divided by 12 months. Monthly sales is assumed to be 1 lakh. Listen me carefully what I am going to speak further. Suppose annual expense of the company is rupees 3,65,000. Then assumption is made that daily expense will be rupees 1,000. How it is 1,000? It is 3,65,000 divided by 365 days. That is the kind of assumption is made. So sales of the company, expenses of the company are evenly spread throughout the year. That is the kind of assumption is made. Basically, friends, this assumption is made with the point or with a kind of argument that, listen carefully, let's say they want to eliminate any seasonal business. Yes, they want to eliminate any seasonal business. Because in case of seasonal business, what will happen? During the peak time period of the season, sales would be high. In the remaining time period, the sales will be low. And because of this, what happens at say the credit period is required to be adjusted, say according to the time period of the season. That is the reason so this kind of simple assumption is made. Third, the third assumption is very similar to what you study in accounts, the assumption of the going concern. What does it mean? It means that so the company has an intention to carry on the business for infinite period. The company does not have an intention to close down the business in shorter time period. That is the kind of assumption is made, which is very similar to what the assumption that you have in accounting standard 1, in which the company has an intention to carry on the business for a longer period of the time. Fourth assumption, uh, I would like to ask a question to you before I explain the fourth assumption. Suppose a company has right now the credit period of 2 months, sales of the company is 10 lakhs, variable cost is 6 lakhs, total fixed cost is 1 lakh. If at all the credit period is increased from 2 months to 4 months, then in that case the company is expecting that the sales will increase from 10 lakh to 20 lakhs. I want you to write in the chat box that in this case, what would be the variable cost and what would be the total fixed cost. So the variable cost will increase from 6 lakhs to 12 lakhs and the fixed cost is going to remain same. In a way that so the assumption is made like this, that the variable cost will change in the proportion to the revenue and the total fixed cost is going to remain same. That is the kind of assumption is made. So these are the four assumptions which have been made. The first assumption is all the sales are on credit basis. Second assumption is that the activity level of the company is evenly spread throughout the year. Third assumption is, say the going concern, the company is going to carry on the business for perpetuity. And fourth assumption is that the variable cost will change in the proportion to the revenue and the total fixed cost is going to remain same. I request all of you to write down a note. Assumptions. In that write down, in order to keep uniformity in all answers, comma, following assumptions are made. Write down first, all sales are on credit, comma, unless it has been given that a certain portion of sales is on cash basis. Second, activity level of the company is evenly spread throughout the year. Full stop. Due to this assumption, comma, we eliminate any possibility of seasonal business. Third, the company is going to do business forever. Full stop. Company does not have any intention to close business in shorter time period. In this, write down further. This assumption is similar to AS1 assumption of going concern. Fourth, most importantly, it is assumed that total variable cost will change in proportion to revenue, comma, total fixed cost will remain same. So friends, these are the basic assumptions which have been made. However, we may be provided with any contrary information. If any such contrary information is given to us, then in that case we are required to follow that instruction. Otherwise, these are the general assumptions which have been followed. Now, I am asking a question to you before we proceed further. Suppose a company has sales of 1 lakh, variable cost 60,000, total fixed cost 10,000, number of units produced and sold 7,000, and let us say that, say, from this information you are required to calculate contribution to sales ratio. Then in that case, what would be the answer for the contribution to sales ratio? Please write answer in the chat box. So basically over here, contribution is calculated. First of all, it is sales minus variable cost. Sales is 1 lakh minus variable cost is 60,000. That gives a contribution of 40,000. The term variable cost stands for the expenses which are going to vary, which are going to change with the activity level, is given a name as technically variable cost. So the expenses which are going to vary, which are going to change in response to the activity level, is considered to be the variable cost. The best examples of the variable cost are material cost, labor cost, variable production overhead. These are the best examples that we have for the variable expenses. And the term fixed cost stands for the cost which is going to remain same, fixed, irrespective of the activity level. Municipal tax of the premises, rent of the factory building. These are the best examples that we have of the fixed cost. So the contribution is calculated as sales minus variable cost. And my question to all of you was contribution to sales ratio. So it is calculated as contribution upon sales into 100. What is contribution? It is 40,000. What is sales? Sales is an amount of 1 lakh into 100 for getting answer in percentage term. So that comes to 40%. And this is the way contribution to sales ratio is calculated. So this is basically the concept that we have in marginal costing. The reason that I'm discussing this right now over here is because what happens, friends, that um, uh, in the chapter of the receivable management, we have certain concepts, say, which we are going to apply over here. See, we are not going to understand it over here. We are just going to apply those concepts, like contribution to sales ratio, which is given an alternative name as the profit volume ratio, the term variable cost, fixed cost. So to some extent, we are going to apply it. That is the reason, I have discussed this point with all of you. I request you to write some basic formulas with respect to the like all these calculations, which you study in detail in your very simple chapter called marginal costing. That is covered in your costing. So I'm just dictating those formulas to you. So I request all of you to write down the some basic formulas. First, contribution in that sales minus variable cost. Friends, why contribution is calculated, I am not explaining that to you, but just would like to tell all of you that, say, we have very good concepts in costing, which is given a name as break-even point, which is given a name as margin of safety, and all those points can be very well understood by you if you learn the concept of the contribution. That is the reason, say, we have that is a concept called contribution. Then second formula, write down contribution to sales ratio or it is given a name as profit volume ratio. In bracket write down PV ratio. So it is contribution upon sales into 100. That is the way the contribution to sales ratio is calculated. It is also given a name as profit volume ratio. Why it is given a name as a profit For that also there is a technical reason. Volume means sales only, which you will study in your very simple chapter of marginal costing. Third is variable cost to sales ratio. It can be calculated by two methods. One is variable cost upon sales into 100. So, like basically in the example which I have just told you, it is 60,000 divided by 1 lakh into 100. That is variable cost to sales ratio. Or otherwise, it is 100 minus contribution to sales ratio. That is also given a name as, say, the profit volume ratio. That is, if at all the profit volume ratio is 40 percentage, then variable cost is 60 percentage of the revenue. Fourth, total cost. It is total variable cost plus total fixed cost. Fifth, total cost to sales ratio. In that it is total cost upon sales into 100. So basically, the example which we are discussing right now, in that we understand it is 60,000 plus 10,000. That is 70,000. 70,000 divided by 1 lakh into 100, that comes to 70 percentage. That is the way, so the total cost to sales ratio is calculated. Sixth, total cost per unit or average cost per unit. Yeah, it will be calculated as total cost divided by number of units. See, the example which we are doing, in that, so the total cost is an amount of 70,000. That is, say, 60,000 plus 10,000. So it is 70,000. 70,000 divided by 7,000, that comes to 10 rupees per unit. That is the way the total cost per unit can be calculated. Now friends, over here, we understand that, say, the total cost per unit, or it is given a name as average cost per unit. Basically, as a student, you may have a kind of like the notion that average means total of something divided by 2. But in this example, it is no. In this example, it is, that is, say, for the purpose of this chapter, total cost per unit or average cost per unit is one and the same. That is what we understand. Now we are going to understand one more concept that is given a name as carrying cost. Or it is given a name as opportunity cost. Now let me give an example to you, say, to explain this. uh, for that, say, I am just, say, giving a kind of example. uh, the kind of stage through which I have passed through. See, friends, all of you are like with a lot of hopes and expectation. All of you have joined CA. Before number of years, even I had joined CA with a hope that I'll pass out my examination. Basically, when I joined CA, everybody was say, telling me that say, Maulin, you should not join CA. For you, passing CA examination would be very difficult. Like that, say, like all my well-wishers were say denying me to join CA. The kind of argument that say, they had was like this: one, CA course is very difficult. Second, the result is very less. Third, you do not have said a very good result in the past, with which there is any message that say you will pass examination. However, I had attended a few very positive attitude seminar, so with the hope that say no, I will do something in life. I have to take a risk and everything. I joined CA. Once I joined CA, I suddenly realized that say this is not my cup of tea. So daily I was doing pratna, I was doing prayers, and with the God's grace, I passed out my examination. So a moderate student like me also passed out the examination, say with the help of God's efforts. See, till the time you do not pass your CA, the life is very simple. It is May, you do not pass. Then November, you do not pass. Again May. So life is May, November, May, November. It was very smoothly going on. However, say one fine day, uh, very surprising to all, I passed out my examination and I became chartered accountant. After passing CA, everybody has to decide that say what to do further. So even I had to take that decision. So I told my dad that said, Dad, I want to start my own startup. That is what I told him. Startup is not a new concept. It was there when I also passed out my CA examination. So my dad told me that, Sir Maulin, I don't mind you starting your own business, your entrepreneur. That is your enterprise. However, first of all, you take some experience. You just try to understand that's the in and out of a business, and then you should like start your own venture. You should not suddenly start with the startup. That is what my dad told me. But I told him that say no, dad. See, you told me not to do CA, but still I passed out my examination. Now you don't tell me not to start my business. I am very confident I will be able to manage my business successfully. But so my dad ultimately uh, he was not happy, but still he allowed me to, because it is very difficult to convince youngsters. You know that. So I started my own business. He told me one thing, say before I started the business. Just can you tell me that say what he must have told me? He told me that say just make sure, Maulin, that say you are not incurring loss in the business. I said okay, I'll make sure. After 1 year, he called me. Okay, just before that, say for the purpose of say, starting my business, say there was an investment which was required 10 lakhs, which I told my dad to finance me. So unwillingly, say he financed me for the initial investment, that is 10 lakhs. After 1 year, he called me that say, Maulin, what is the result of your business? In the first year, whether you have made profit or loss. That was his first question to me. I replied him that said that in the very first year I have made a profit. So he was very happy that in the very first year you have made profit. Then he asked me that say, Maureen, what you're expecting say, about the growth of the business. I told him that said that I'm not expecting that say the growth in the business, the kind of the business in which I'm dealing in, I'm not expecting any growth. I'm expecting that say whatever the business that I made in the previous year, in my first year, the same business I will make subsequently. Okay. Then he inquired with me that, say, Maulin, what is the amount of the profit that you have been able to make? I replied him that, said, Dad, I made a profit of 7,000 rupees. That is what I replied him. He said, okay. Then he told me that, Simolin, let us go at a place. I said, okay. So he took me to State Bank of India. I think that's all of you must have heard about State Bank of India. Then he told me that, say, Maulin, you just go and inquire that what is the rate of interest for 1 year deposit. I made inquiry that the rate of interest for 1 year deposit, and it was found to be, let us say, 8%. So I told my dad that, said, Dad, I have made, that is, say, the rate of interest is 8%. So my dad explained me something like this. He told me that, Maulin, if at all we invest is 10 lakh rupees at the rate of 8%, if we invest is 10 lakh rupees at the rate of 8%, then interest income will be 80,000 rupees. And honestly, for this 80,000 rupees, you don't have to make any effort. For this 80,000 rupees, you don't have to make any effort. Without doing anything, you can earn an amount of 80,000. For the entire year, you have done business, and say you are making a profit of rupees 7,000. In future, you are not expecting any growth. He asked me a question. Maulin, do you think that, say, this business should be done in future? What is your reply? The answer is no. This business should not be continued. Reason for that is very simple. See what happens at, say, by doing business, I have made a profit of 7,000. If at all I do not do anything, then in that case, from this 10 lakhs, I can earn an amount of 80,000. And in future, I am not expecting any growth in the business. So definitely, this business should not be carried on, and I must stop doing business. That is what we understand. We understand over here, technically, understand that. So the opportunity cost of doing business is an amount of rupees 80,000. See, always there is an intention that, say, you make profit in the business, but only profit is not sufficient. Taking into account the investment that you make in the business, based on that, you should be having, say, some minimum amount of the earning, and that minimum amount of the earning is what we understand is opportunity cost. So your opportunity cost is an amount of 80,000, and so you earn only an amount of 7,000. So from the decision making point of view, we can say that, so the business should not be carried on. This is what we understand. I request all of you to write down a note, heading carrying cost. Slash opportunity cost. In that, write down first point. For any commercial enterprise, always there is an intention of making profit. Second, only profit is not sufficient. Full stop. Taking into account investment made in the business and cost of capital of the company, comma, the company should be able to generate some amount of minimum profit. Full stop. This minimum profit is called carrying cost. Third point, from decision making point of view, we can say that if actual profit is less than minimum profit, comma, the company should not carry on the business. Full stop. Friends, over here I have dictated a word to you, term called carrying cost. It has a simple meaning for the time being, 8% in this example. And the carrying cost is an amount of 80,000 in this example for the time being. Let us see a question. Consider following information. So we have been provided with a set of the information. Annual credit sales is 401.5 lakhs. Annual variable cost is 300 lakhs. Annual fixed cost is 65 lakhs. Average collection period is 60 days. Cost of capital discounting rate is 20%. The question says that to calculate annualized carrying cost. I request all of you to go through the question, please. So before we do answer of the carrying cost, I have a few questions to all of you. Please write in the chat box that what must be the daily sales of the company. Do not write anything, just answer me in the chat box. So the answer is an amount of rupees 1,10,000. So it is 401.5 lakhs divided by 365 days. That is the daily sales. My next question to all of you is, what is the daily cost of the company? Please write answer in the chat box. We understand it is the annual variable cost is 300 lakhs plus annual fixed cost is 65 lakhs divided by 365 days. So the daily cost of the company is rupees 1 lakh. That is the way, so the daily cost can be calculated. My next question to all of you is, what must be collection of the company during first 60 days of the business? I repeat my question. My question is that, say, what must be the collection of the company, say, during first 60 days of the business? I request you to write answer in the chat box. Answer is 0. What is the collection during the first 60 days of the business? Is 0. Why? See, understand that, so the question is providing the information that, so the average collection period is 60 days. Means day 1, day 2, day 3 till 60 days. During the first 60 days of the business, we understand that, say, there is like no collection. You will start getting the collection from 61st day onwards. Whatever the sales that you have made on the very first day, for that you will get the collection on 61st day. That is an amount of 1,10,000. Sales of the second day, that will be collected on 62nd day. What is the amount of the collection? Again 1,10,000. And so on. So what will happen? From 61st day onwards, we will be able to get the collection, and that is the reason, so during the first 60 days, so the collection will be 0. That is what we understand. Now coming back to the point, listen carefully now. We understand that, say, during first 60 days of the business, there is not a single rupee collection. However, so the daily cost is an amount of 1 lakh. So what will happen? We understand that, so over here, daily cost is 1 lakh multiplying with 60 days. So there is a cost of an amount of 60 lakhs that we would have incurred during this time period. And another thing that, say, what I'm going to explain is this. Once 60 days business is over, after that the company will start receiving collection. Rupees 1,10,000, out of which profit of rupees 10,000 will be withdrawn, and remaining rupees 1 lakh will be reinvested in the business. So repeat that. What happens, I'd say, you will receive an amount of 1,10,000 from 61st day onwards. From that, so the profit of 10,000 rupees will be withdrawn, and the remaining 1 lakh rupee will be reinvested. So once 60 days of the business expire, you don't have to make a single rupee investment. Whatever the cash flows that you will start receiving from the business, that will be reinvested in the business, and you don't have to invest a single penny. However, this 60 lakh rupees of the investment that you have made, that could have been made somewhere else. Yes, the question is providing the information about the cost of capital of the company. What is cost of capital? Cost of capital is given to us in the question is 20 percentage. So this 60 lakh rupees could have been invested somewhere else at the rate of 20 percentage. So 20% of 60 lakhs is rupees 12 lakhs. So we understand that, say you are having an opportunity cost for an amount of rupees 12 lakhs. So 12 lakh rupees is, we understand that's the carrying cost, and that is the minimum profit that say you should be able to generate from the business. Only in that case doing this business is justified. This is what say we understand is the kind of interpretation of the carrying cost which we compute like this. So I request all of you to write down answer along with me. Heading, write down carrying cost. In that, write down total variable cost plus total fixed cost divided by 365 days. So we will get that 1 lakh rupee daily expenses into ACP, average collection period, into K, cost of capital. I am writing this answer in detail. 300 lakhs plus 65 lakhs. So annual cost is 365 lakhs divided by 365 days into average collection period into cost of capital. So it is 1 lakh into 60 days into cost of capital. 60 lakhs into 20 percentage, that comes to 12 lakhs. That is the way, so the carrying cost is calculated 12 lakhs. So the term ACP stands for average collection period. The term K stands for cost of capital slash rate of interest slash capitalization rate something like this. A word can be assigned. Average collection period is also, we understand, credit period for the time being. This is what we understand. This is something that's importantly you need to understand. Once 60 days of the business is over, after that the company will start receiving the correction, out of which the profit is withdrawn and the remaining amount will be reinvested in the business. So you don't have to invest after 60 days. This is the carrying cost.